Hi, good evening, ladies and gentlemen. Thank you for joining to a unique session. You must wonder why I'm saying why unique session, because instead of normal PPT followed by Q&A, today we'll go straight into interactive format, where I'll be asking some question on your behalf and we'll be getting addressed on these questions. My name is Santosh Shetty. I'm a product head for investment, research, and real estate distribution at Motilal Oswal Financial Service. Our focus for this session is a topic that lies at the heart of every investor aspiration: stability and growth, the right addition to mutual fund portfolio. To address the same, today we have with us a distinguished expert in the area of investment and portfolio management, Mr. Akhil Chaturvedi, who is a director and a chief business officer at Motilal Oswal AMC. Mr. Akhil comes with a wealth of experience and insight garnered over 20 years of navigating the complex landscape of investment strategy. Over these years, he has connected with countless individuals and institutions towards making informed and strategic choices in their investment journey. With this brief introduction, let us start the session. Akhil, coming to state to my first question, could you give us an overview as to why balancing stability and growth is crucial when selecting mutual fund for an investment portfolio?
Yeah, thank you, Santosh. Thank you for this opportunity and good evening to all the audience. It's a pleasure talking to all of you. Santosh, to your question, clearly we all know that when we invest in equities, we are investing in an asset class which is inherently risky in by nature. It is an asset class which is volatile, and we all know that markets generally are not they don't go in one line, so they will have their own ups and downs depending on various scenarios, and prices of companies also will go up and down depending on the moods of the markets. So in such kind of an asset class where risk is involved, obviously one has to tread the journey very, very carefully, and there are rules and there are do's and don'ts. So if one does asset allocation properly, and then within asset allocation, if you diversify the risk between stability and growth, the journey will be a lot more smoother, a lot more comfortable, and it will give you less of heartburns. Now, when we talk about stability, obviously we have to keep a reasonable part of our portfolio in the blue chip companies of our country. Now, what do we mean by blue chip companies? Are companies basically which have been in business for several decades, 20 years, 30, 40, 50 years. They have proven track record. Managements are extremely pristine, shareholder friendly companies, very strong balance sheets. So the track record is extremely good. These are very large companies and their market caps are also very large. And therefore, these companies by default become relatively lesser volatile or lesser risky. So this part of the portion which you could say that the top 50 or the top 100 companies of India are probably the blue chip companies as we would define it. So if you keep part of your portfolio depending on your risk appetite into the top 100 companies of India, by default will give you the stability quotient. But as we all understand, as financial professionals, if you take low risk, the returns also will be lower. So when you choose stability over growth, then obviously you're trying to reduce your risk, and therefore you should be prepared for slightly lower returns. Lower also will be good. It's not that it's going to be bad, but yes, you will get your downside protection, but your upside will be limited to a large extent. But you will get your stability quotient. The other part is growth, right? I think you talked about stability and growth. So the other part is growth. Growth is where we are looking at businesses which are part of the market cap bucket, which is falling into the mid cap space. One notch below will be the small cap space, and even below will be the micro cap space, right? So mid cap companies will be young companies, but they would have spent 10, 15, 20 years. They would have some track record, still emerging, maybe smaller balance sheet. So by the nature of this segment, it will be slightly more volatile than the large cap bucket. You go down to small cap, they are even younger companies. So as you're going down the market cap bucket, basically companies are young, they are emerging, yet to prove their mettle. But within this space, you will find a lot of companies where the managements are very hungry for growth. New opportunities are coming up. And therefore, what we have seen over long periods of time is that the mid caps and the small caps or the companies falling within this market cap bucket will give you much higher growth, which means that the potential to earn higher returns is therefore that much higher. But it will come along with its own nature of volatility. So if I have to put it very simple for a layman investor, mid caps will be more volatile than large caps. Small caps will be more volatile than the mid caps, and micro caps will be even more volatile than the small caps, right? So as you keep going down the bucket, the potential to make higher returns is there, but there would be chances of drawdowns. There will be chances of going through a lot of volatility, period of pain, and therefore, typically when we advise our investors, how do you do your market cap allocations, is that if you're looking at mid caps and small caps and micro caps, you should typically have a very, very long term kind of a horizon, starting with 10 years and then going up to 15, 20 years. Large caps, maybe you can have maybe a smaller investment horizon, but as you go down the market cap bucket and you go more towards growth, your investment horizon has to become longer, because the only way you can hedge your risk while investing in markets is basically time. So the more time you give, your risk profile, your risk will start to come down, volatility will also ease out, and chances of creating a lot of wealth over long periods of time will become that much more higher. So the long answer to your short question was that the difference between stability and growth is nothing but having some part of your money in nice stable companies, keeping your capital relatively safe, but being prepared for reasonable returns. Some part of your money should be in the growth, which will be coming from the young companies, emerging companies. But in either case, you need to have a long-term horizon to live through the ups and downs and create a lot of wealth.
I think you had an excellent connotation saying that it's more of a timing, not more than timing, it's time in the market is more important. And if you
Yes.
stay invested for over a period of time, automatically the volatility will come down and you possibility of making stability as well as making growth in your portfolio. It goes multiple times higher when you hold it for a long period of time.
Absolutely.
So the question comes up when you say long, what actually is long period? Is it 3 months, 6 months, 1 year, 2 year? What do you mean by long and what do you mean by short? From an equity perspective.
So if you want to understand long-term, short-term, I'll give you two answers. One answer comes from the most successful investor, the most richest investor who has made his lifetime wealth through equities is Warren Buffett.
Correct.
Now, Warren Buffett's long-term starts or short-term starts with 10 years, right? So that is his short-term 10 years. So you can imagine what I'm saying, right? I'm saying that at least let's start thinking of 10 years and more as long-term, whereas the most successful investor, the most richest investor looks at 10 years as a short term. So that's the answer from one kind of investor. The other quote or reference point I'll take is our own boss, Mr. Ramdev Agarwal. What he says about long term is till such time you make your desired returns. So when you invest in a particular asset class and your target return is, let's say, X percentage, till such time you achieve your target, you have to remain invested. Now that could happen in 2 years, 3 years, 5 years, 7 years, nobody knows. But once you achieve your target, your job is done. So long term is till you reach your desired return. But one has to keep in mind that one long term will also have many short terms. So when you look at 10 years, 10 years is made of 10 years, 20 half years, many quarters, right? And through those quarters and half years and 1 years, you will go through all the ups and downs. And average of all the ups and downs is what you get in terms of your CAGR returns, right? So which again, coming back to the answer I gave you to the previous question, which comes only with time. See, equity, we speak about compounding, right? Compounding works with T. So if you go back to classroom, all of us, those who are on the call, I'm sure you remember what compounding means. The formula of compounding is very simple, right? So A amount is equal to principal into 1 plus R upon 100 raised to power T. Now that T raised to power T is the most crucial part, time. And time is what we have control upon. R, which is return, we don't have any control. So all what we have control is time, and time is what we should focus on. Return will come along with time, right? So that would be my my answer to again your short question. I
Yes,
would say start with 10 years. Anything less than 10 years is you make money, it's good luck. You don't make money, it's bad luck. I would say put it that way.
correct. Ladies and gentlemen, the reason why I asked is, as per income tax, 1 year is long term and less than 1 year short term. But when you actually come to investment, logically it should be upward of 5 to 10 year plus. It can't be a 1 year or 2 year, because there could be a phase where last cap may be doing good, but not necessarily a mid cap or a small cap. But when you hold it for 5 to 10 years, all these funds will give you a very decent and sustainable growing returns. So that's the reason I thought about talking about it, because in say real estate or in case of debt, we look at 3, 5 plus year horizon. But as far as equity is concerned, we only look at 1 year plus, which is not the right frame of looking at it. Look at from 5, 10 plus years. So the next question, since we talked about market per se, for the last 1 month to 2 months, we have seen that Nifty has been range bound or maybe slightly corrected by 2 to 3%, except for today. But on small cap and Nifty mid cap are going up on a regular basis over the last 1 to 2 months. So what's your thought on that?
Yeah, so that's an interesting question. I'll answer that in two or three parts. The first part is that generally speaking, mid caps and small caps tend to do well in rising economic cycles, which means if economy is doing well and it's in the upward trajectory, then typically businesses which are more inclusive, more linked to the domestic growth will benefit in terms of growth. So therefore, mid caps and small caps, where these businesses are more based out of India and trying to cater to Indian consumers, will benefit from the growth which is coming from the underlying economy. So one reason for mid caps and small caps to do well is that the Indian economy has been doing well. It has come back very, very sharply from the pandemic times. In fact, we are the fastest growing economy, and we've seen the first quarter number, which has been 7.8%. So let's hope the trend line is only going up and up. So that's answer number one to why mid caps and small caps are doing well. The answer number two is more fundamental. In the last 3 years post COVID, we have seen that the earnings growth recovery in the mid cap and the small cap has been much, much higher than as compared to the companies which are part of the Nifty 50. So I think last what I remember is that the mid cap companies, which are 150 companies in the mid cap basket, has grown at about 35% profits, earnings growth. Small caps have grown even higher than the mid caps, and fundamentally markets will always reward earnings, and therefore the first reason that the companies are doing good because of the economy doing good. Secondly, that is reflecting in the growth of profit, and growth of profit is reflecting into their price growth, what we are seeing in the last couple of years. And third thing, more specifically in small cap, because in the recent past small caps have done even better than mid caps. Again, apart from the first two reasons, small caps as a space has been beaten down for far too long now. So for the last 6 years, broadly the index has given virtually no return. So there was, there was a huge opportunity to invest in small caps, because you had a very long period of time correction. Valuations had really come down very, very sharply, and earnings growth had gone up pretty sharply. So smart investors started to allocate directly through equities and through mutual funds. Also, we are seeing almost 4-5 thousand crores of monthly net flows in the small cap category. All of these flows are basically getting channelized into the small cap stocks, and that's where that liquidity is driving the small cap. And I feel that the trend would continue for some more time. I do feel that when you look at a 5 year or a 10 year kind of a horizon, we spoken about the economic growth, and we are talking about a doubling of economy to $6-7 trillion. As long as that journey is on track, I think mid caps and small caps have full potential to outperform the large caps over that kind of a time frame. In near term, we can say that there is a slight premium of the mid cap universe over the large cap, and small caps also were available at discount 6 months back. Now there is a slight premium of 8% over the Nifty. So therefore, I feel that if you are trying to time, or you're trying to assess that is it the right time to enter, I would say that maybe you can look at staggering off over next 6, 9, 12 months. So just in case for some reason there is some correction, some volatility in this space because it has run up very sharply in the short term. So there can be a correction also in the short term. So a good strategy to invest in mid caps and small caps, given current valuation, will be to stagger it off over a 12-month period. So you can benefit from any kind of emerging volatility. So for near-term investment, I think large caps seem to be a safe haven at this stage. Mid cap, small caps, good for long term, and the entry strategy should be through the SIP STP route.
Taking the point forward, specifically on mid cap, what are the potential advantage of investing in a mid cap fund, and what should an investor consider before allocating fund for mid cap in their portfolio?
No, the advantage, like I explained to you, is that see, like I said, that as the economy is doing good, obviously the mid cap companies are getting a very good advantage over playing out the economic cycle through their through the business cycle momentum. Number one, the earnings growth upwards of 30-35% itself is a very big blessing, right? Uh, so those are the two main reasons why mid caps are doing well and are likely to do well in the future. A lot of the businesses are now, in the new definition of mid cap, are actually not really very small. I mean, we are talking about businesses which are $2 billion or $3-4 billion in terms of their market cap. So these are really not small businesses, and it's very likely that over the next 5 periods, a couple of companies in the mid cap segment may migrate into the large cap segment. Right. So when that transition happens, there is a wealth creation study of Ramdev Agarwal titled Mid to Mega. A lot of the tomorrow's mega cap companies are today's mid cap companies. So a lot of new ideas, new entrepreneurs, new business models are there today existing, in the mid cap segment. And at this kind of a growth rate, it's very likely that some of these will move into mega caps, which will be the top 100. So that is the optimism around the mid caps, right? And your second question was,
what factors should the investor should consider before investing in mid cap?
Yeah,
as to how much you should allocate to mid cap fund?
Yeah. So how much you want to add to mid cap fund will depend on your age and your risk profile and your liquidity requirements. But if I have to, the only single factor you have to keep in mind while investing in mid cap, that it is more volatile than large caps. Given the current run up, what we have seen in the last 2 years in the mid cap segment, I will not say the valuations are frothy, but I would say that there is a premium. So therefore, there could be near-term time correction or price correction, and therefore you have to keep in mind that you need to invest, but you need to invest by spreading off over the next couple of months. And the second thing, what we discussed earlier, that you need to have a very long time horizon in your mind when you are allocating to mid caps or going downwards, right? So these are the two things keep in mind. Current valuations are slightly more pricey as compared to what it was 2 years back. So we have to be cautious when valuations are expensive. And the best way to play that out is staggering of your investment. Having done that, you still need to have a long-term horizon. So one needs to keep that in mind. So keep these two factors in mind. How much to allocate? I mean, typically, I would say that 100 minus your age should be your equity. Within that, if you are in the middle age bracket in terms of your age profile, let's say between 35 and 45, I think 40-50% allocation to mid cap, 10-20% to small cap, rest large cap is a good allocation. But this is all, I mean, this is where you and your team, Santosh, will help investors to assess their risk profile and tell them the right allocation. Because it's very individualistic. It's
Definitely
very difficult. But I can sorry, I'll just take one more minute. The best way to play this out is you come into funds which is investing in all market cap buckets. I mean, why to choose one over other? So we have this flexi cap category, we have the large and mid cap category, we have the multi cap category. Just come into the funds. A fund manager will do allocation between large, mid, and small depending on which cycle is looking good. So you have solutions for these available, so you can choose, but take help. I would strongly recommend.
As a distributor, we get this question a lot: when is the right time to start an SIP?
Tomorrow. Tomorrow morning, first thing.
Because normally we keep on asking and we never start. I think that's the best thing. I would say if we're doing this session at 10 o'clock in the morning, we could have done it today itself.
Yes, absolutely. See, I mean, you're saving, right? If you have money, it needs to be either consumed or saved. So consume less, save more. That is how, if you want to create wealth, you need to come inside as soon as possible. See, there are 3 mantras to make money in equity markets. And I've been using this for now over 2 decades. I learned this from my first boss back in 2000 when I used to work with the Bidlas. So what this motto is basically, to make a lot of wealth, you need to start very, very early. The earlier you come, the better it is, because we spoke about compounding formula, raised to power time. So if you start investing at 25, you have 35, 40 years to earn and save and compound. If you start at 30, you have 5 years less. If you start at 40, you have 15 years less. Every year will matter in creating wealth, right? So start early. The second thing is, especially in equities, invest regularly. There is no good time, no bad time. In fact, in bad time, this is the best time to invest. So keep investing. We don't know when good time will be there. We will not know when bad time will be there. Nobody had any clue that we are going to be attacked by COVID. Everybody was taking it easy till our prime minister came and said there's a lockdown next day, right? So invest early, invest regularly, and invest for long term. These are the 3 things keep in mind, and start today. Start today.
As you said about like 25-year-old. So if you are to ask to create an ideal mutual fund portfolio for a young 22 to 25-year-old salaried person, what sort of fund he should be having in his portfolio and why?
What kind of fund?
Yeah, what kind of fund should be there in a portfolio? Should he be like 100% equity, or should you think he need to have something?
I would say like this typical formula 100 minus 8. So if somebody is 25 years, 100 minus 25, 75% is a typical allocation. One can be even 100% at that age, but I would say that 75% of equity, 25% of debt, and debt or gold or whatever it may be. It's good to diversify. And within the equity allocation, there should be higher allocation to mid caps and small caps, because you have a lot of time in your hand to go through the volatility and then create more wealth. And maybe 30-40% allocation to large caps for stability. So stability and growth both will play out. And for our young investors in this age bracket of, or who have just started to earn, or under 30s, I think you have time on your hand. So therefore compounding will play magic. And let me tell you one thing, that we are talking about Amrit Mahakal for India. We are talking about India at 100 in the next 25 years. Next 25 years, 2047, we are talking about an economy which, even if you grow at today's growth rate, which is 9% in dollar terms, you are talking about an economy size of $25 trillion for India. We will be the second largest economy, right? Our per capita income will be more like $10,000, $12,000. My friends who are today 25 years are actually going to live the India at 100. We both of us might be very old, but these young guys will be young then also, right? So imagine a $3 trillion economy going to $30 trillion. Even I have to say that if market cap to GDP is 100%, market cap to GDP, so today it is 100%. If after 25 years 100% is 100%, then the market cap will grow 10x from 3 trillion to 30 trillion. So for my friends, believe me, I wish I had time machine and gone back to your age of 25 years. Because when I was 25, I had nobody to explain all of these things to me. So I wasted 10 years only spending, and I started to save only 10 years afterwards. So I lost my 10 years of compounding. But my recommendation is that for young investors, and most young guys are very smart nowadays. They come from well-to-do families. You have good support system. So as much as your money, you should put in SIPs.
Can you just tell us briefly about Motilal Oswal mutual fund investment philosophy that is followed?
So we have a very simple investment philosophy. We believe in investing for long term. We believe in buy and hold strategy. To do buy and hold, when you want to buy businesses for long term, you need to focus a lot of your time has to be spent to invest in very high quality businesses. So the first framework what we use is the quality framework, trying to assess the quality of business run by quality of management. Both has to be extremely pristine, good business with good moats, run by very, very strong and transparent and ethical management. If so, that stability part, what we discuss, comes from quality, right? Quality is 90% of investing, because again, going back to the two rules of Buffett, rule number one, don't lose money, and rule number two is don't forget rule number one. So if you don't want to lose money in equities, you have to spend a lot of time understanding the quality, because in quality, the downs will be temporary, ups will be permanent. That's how I would put it, right? So our first framework is do a very strong check on quality. Once the quality check is done, we focus on growth. Growth is the growth in the profits, because eventually in long term, price growth will be equal to the earnings growth. So quality will give me downside protection, and growth will give me the upside, right? And then we are looking at buying quality and growth at a reasonable price. So if you buy good companies at wrong price, then you will make money, but the waiting period will be that much more longer. So valuation consciousness you needs to be there at all points of time. So we are basically using these frameworks, quality, growth, and valuations or price, to basically create our universe of 300 odd stocks, and then our portfolios would have typically 25-30 stocks from the overall universe. So that is our style of investing, and yeah, it has worked so far.
Very good. How frequently do you think should investor review their portfolio and potentially rebalance that mutual portfolio to ensure that it remains aligned with the stability and growth goals?
So see, it's a good question, but I don't know how to answer this. So your asset allocation part should be constant. Your asset allocation, what has been decided, should be reviewed maybe every 3 year or 5 year, because as your age will progress, or the band of your age changes, then the risk profile will change. Therefore, the asset allocation has to change. So the review of asset allocation can be done in a longer frequency. A review of the underlying portfolios can be done maybe on a yearly basis, just to assess whether all the underlying funds which you have invested in are in good shape. See, if your fund is not doing well, doesn't mean it is in bad shape. Correct. Maybe that fund is going through a style correction or something. But if there is inherent risk or inherent issue with one of the funds in terms of the way the fund is being managed, then if it has to be changed, it can be changed in that review session. In fact, it can be done before. So ideally, I would say annual review on underlying portfolio, and maybe 3 year, 5 year review on your asset allocation. See, I have seen that the more you review your portfolio, the more you monitor your portfolio, the more you monitor your returns, it will lead you to take irrational actions and decisions. So the less you see, the less you act, and more you compound. The more you're going to see, the more you're going to do changes, and in and out and all that stuff. That much in equities, I've seen that more the activities, less the return. Less the activities, more the return. So try and do less activities. It is an investment which you want to use after 10, 15, 20, 30, 40 years. Then you don't need to sweat on what is happening in the market today, what is the NAV today evening, what is the NAV tomorrow. Try and avoid to see or track your portfolio in short term, and then you will really enjoy the long-term benefits. You can see any mutual fund with a 15-year, 20-year track record. All funds have given 15, 16% compounding, which means most of the funds are up. I mean, there are some funds which are up 100 times also, 1,000 times also, right? So those who have invested for that time frame has actually seen 10 lakh rupee becoming 100 crore sort of number. So that all is there, right? So these are some of the things. Less review, I would say, but still, if you want to review, then review on a yearly basis, and don't take decisions.
Hey, ladies and gentlemen, I'll just give an analogy to you. Like for someone who's a salaried employee, okay, and he has EPF. On a monthly basis, we have a SIP going on in an EPF employee provident fund. How many of us are actually checking the portfolio on a monthly or a yearly or half yearly basis, or even 3 years basis? No, most of us don't look at it. Now, after 10 years or 15 years, when you look at the EPF portfolio, you say, "Hey, a huge amount of AUM has been created." But unfortunately, in case of equity, though I start with a 5-year SIP, 10-year SIP, or 15-year SIP, moment I invest today, very next month I start reviewing it. How is my fund perform vis-a-vis index? How has perform with other counterparts? But do you really want to do that? Logics, what Akhil is saying is, if I invested, what right, sit tight with it. review it, but don't take an action for the sake of taking action. As we said in the very first question, that when the long term basically means 5 plus 10 plus years. So take investment as if you are planting a tree, keep watering it, keep putting fertilizer, take care of it, and within 5 or 10 years, depending on which tree you are planted, you'll get a fruits which you enjoy for life to come. So think that you are planting a tree and start your SIP in that format.
Absolutely, absolutely. I agree with you, Santosh.
I just, since we're talking about that people do churning on that basis, so there is another question of mine is, a recent study has shown that investors hold mutual fund on an average between 2 to 3 years. Why do you think is this happening, and what advice do you want to give a new investor?
So
you already addressed it, but for specific this question, because we have seen that we come with a 5, 10, 15-year horizon. We say goal is for my retirement, but why is it average holding period is 2 to 3 years, be it SIP or be it lump sum?
the issue is that we do very frequent reviews. That's why I said that we should do less review. We should not see our portfolios every day, every week, every month, every 6 months. If you have invested for 10 years, look at it after 10 years only. You know, there's a story in childhood we would have read, if you, I don't know if you remember, story on Rip Van Winkle. You know, there's this guy who leaves his home in search of work, and goes down. I mean, while he's roaming around, he goes down and falls off to sleep under a tree, and wakes up only after 25 years. So when he's leaving he's young, his family is young, kids are small, all those kind of things. And after 25 years, when he wakes up and goes back to his home, you know, the kids have grown up and the house has become big and everything is looking good. You know, so in 25 years, when you open your eyes, you know, suddenly everything has changed. So but the moment you start looking at short term, is where, like I told you, you know, if you're going to monitor regularly, you will be forced to take regular actions and decisions. And when you are going to do too much of churn in your portfolio, it will only destroy your wealth. Right now, I'll tell you why this happens. This issue happens that people redeem every 2 3 years, because in mutual funds, what I've seen is people tend to buy the best performing funds of the preceding 3 years. Right, so just do descending order. Whichever the best performing fund, the top three funds will get one third, one third, one third allocation. Now, one has to understand the schemes which are doing very well on the 3 year or 2 year or 1 year, very, very, very well. That's why they are number 1, 2, 3, is because the underlying portfolio has done very well and the stocks have done very well. Therefore, also one has to be cautious that the valuations will be expensive. Best performing fund of the past will generally go through a mean reversion in the near future. So when you buy today, like today, if I want to allocate 1 lakh rupee and I buy the best performing fund today, then typically what will happen is in the next 3 years, the results will be completely opposite of what I have seen and I have come. And after 3 years, when you are not happy because you were expecting X and you got X minus 50%, then you get irritated and you want to sell it off. So you sell it off, and then again you allocate your money in the best performing of the past 3 years. And then again, after the next 3 years, again you have that issue. So like that is every 3 years when we are buying, selling. I can tell you with greater amount of certainty that average return of investors in equities is 8-9%, because they buy the tops and they sell the bottoms. Actually, what we need to do is the reverse. We need to spend a lot of time to understand the fund house, the fund philosophy, expertise, track record, fund manager, portfolio. And when you find that, yes, these guys, I found a good fund manager with a good philosophy, with a good process, with a good portfolio, and the performance is not good, which means the valuations are looking good, margin of safety is higher, there is where you have to invest, so that in the next 3 years, when that fund goes through an upside, is where the money is made. So in investing, especially in equities, you need to have a counter cyclical approach. Spend 90% of your time understanding which fund manager you want to give money, and 10% of your time when to give that fund manager. You should, best time to give that fund manager the money is when that fund manager is going through a bad time. That is how the foreign institution investors invest. They are continuously evaluating all portfolio managers they want to work with, and then they approve the managers they want to work with, and then they wait for that manager to go through a down cycle. And in that down cycle is when they make their allocation. This is how the foreigners invest.
My final two questions for you, Akhil. On a personal note, how is your asset allocation placed? How do you go about your investment process and what you do during the period of high market volatility. Because being a part of MOMC, you believe in skin in the game. So you definitely have your investment in Motilal Oswal mutual fund schemes. And there have been period when market has corrected or the scheme has underperformed. How do you go through during that period?
So I will not lie. You're talking about me personally?
Yes, yes, on your
Yeah.
personal fund.
Yeah. So if you remove my real estate investment, I don't call it investment, it is consumption. So if you remove that part, I'm 100% equities. I don't have a single liquid fund. I don't have any fixed deposit. So you have to trust me on that. Number one. Number two, in the last 15 years, I've been a very disciplined SIP investor, and I have not broken any SIPs. I have not changed the funds which I had allocated. Then I have only increased it. I have not never decreased it. And and it's not that all the funds where I've invested are doing well. In last 10 years, I would say that 90%, 95% of my mutual funds I own is Motilal Oswal mutual funds. And now by default, I have to invest because there's a regulation. So I would say that 100% in equities, 100% in Motilal Oswal funds. And out of 7 funds, 2 of our funds are not doing well, 5 are doing well. I have all of them. Now, when they will do well, the others will not do well. That's a cycle which one has to play out. But I don't. I have rarely stopped any SIP, even if if the fund performance has not been good. I have. I don't think I have stopped any SIP. I have changed the fund managers. I've just been there for 15, 20 years, and I'm pretty happy with the way the compounding. I mean, you will not believe that even in times like COVID, when the market goes down 40%, in those years also my compounding has been 14, 15%. Right? But that comes because of time, because that cushioning has been built into the portfolio in that 10, 15-year time frame. So that is
Plus you didn't do any review basis market.
No, I
You
know
said,
no
okay, I
review.
stayed investor out here.
No, I don't see only. I don't know the password of value research where I have put the. I don't want to see it. This is
And the
the time
last
to
one,
make money, not review money. We'll
and the
see it when
last
we
one
do.
is, Akhil, for the benefit of people who are joining today, what for that enriching of that knowledge on market as well as self growth, any books you would like to recommend them, so that along with the market reads what they read in the newspaper or the TV media, what are the 1 or 2 books you would recommend them so that it will help really understand the power of investing right now, continuing investing and staying investing.
So, I mean, there are many books, but I would say that, some of the authors, and they have their books are fairly available, but I like to read or hear a lot of blogs and interviews of Warren Buffett himself, Warren and Charlie Munger, because they talk in a very simple language and which a layman can understand. Layman like me can understand what they are trying to advise or counsel all of us in terms of how we manage our behavior. So I like reading them quite a bit, and you would have seen I've quoted 3 or 4 quotes from these guys only. Some of the other people in the recent past who I've started to follow have been, of course, Howard Marks. There's a book called Ray Dalio Principles. So these are some of the books I've been reading. There are a few more, but these are some of the popular ones I would recommend that you use. And if you don't like to read books, then there are a lot of videos available. Just do a Google, YouTube, and hear them out when you are traveling or something. They will teach you a lot. And one thing I've learned from all of these great investors is that all of them have made money only by buy right, sit tight principle, remaining 100% invested in equity, long term 50, 80, 100 years of kind of a longevity, and no speculation, no leverage, no derivatives, no long short, no nothing. Okay, plain vanilla buying good listed companies and sitting over them for 30, 40, 50 years, allowing them to compound. So believe me, trust me, read it, you will understand it, right? But apart from that, I would say that we need to be aware of what's happening in the current affairs. So I'm more of a reader in terms of what's happening through newspapers, print articles, research reports. Following people like Ruchi Sharma and stalwarts like them to just to get more hands-on experience or understanding of how the world economy is looking like, how within that, how India is looking, where are the opportunities, where are the sweet spots, what is, I mean, macros, micros. So you have to spend or you have to split your time between being up to date on what is happening today, and what is happening today, and what kind of an impact it can happen in the future, because that will help you decide where you want to invest and how much you want to invest and which asset class you want to invest. And to understand about behavior and to understand about discipline and learn how to be successful investor is where you need to follow the successful investors. So these are some things which I do personally.
That's great. That's really great. So on the parting note, anything you would like to suggest our audience who joined in on today?
So I would just want to end by saying that the motto which I spoke in between about starting your investment journey as early as possible. If you have not done it, then please do it. Uh, Invest on a regular basis. Don't stop investing if the markets are down or the markets are up, and have a very, very, very long term kind of a mindset. So put only that much money, especially in equities I'm talking about, only that much money which you may not need for minimum of 10 years. So even if it is 10% of your portfolio, at least that 10% portfolio can become 100 after 10-15 years. So it should not be touched unless it is a rarest of the rare kind of a event. And so those are the things which you should keep in mind. And on a parting and optimistic note, I'll tell you that we are really in one of the most amazing times for India, I think, which like I was hearing Ramduji yesterday in one of the seminar, and he said that what we will witness in the next 25 years, hopefully, is what China experienced in the last 25 years, when their economy was growing at 12% dollar terms, and we were growing at 9%. If we can go to 12% dollar terms, China is clearly going the other way around. You can imagine that what happened in China was 3 trillion has become 17, 18 trillion. This is what exactly will play out for India if everything plays out well. And in that, believe me, so much of prosperity for the country, so much of prosperity for people, savings, infrastructure, and also opportunities to create wealth through our stock markets. And the clear difference between what China has done and what China is doing now, and the difference between us, is that we are a democracy, they are an autocracy. So first they made people make a lot of money, now they are trying to clip their wings. But since we are a democracy, even after 25 years, you will not have an autocrat trying to clip your wings. So they will democracy will allow you to prosper and grow for infinite time, right? So that is the difference. So I think we have a huge potential. The size of our country, the potential, the young population, really exciting, right? So on that note, probably I'd like to thank you once again for this opportunity and all the relevant questions. And I hope our people, those who are hearing this call, have gained some bit of wisdom or experience or knowledge to help them make their investment decisions much more wisely and thoughtfully. Thank you so much.
Great. I think Akhil, we are ending on the very good note. If I had to summarize, basically you're saying three important parts. One is basically start early, keep investing irrespective of what happens to the market, and most important part, conviction to stay invested. Because if you stay invested for a long term, and when we're saying long term, it really means 10 plus years. So if you're coming for a large cap, minimum 5 plus years, mid or small cap, 10 plus years. If you stay invested for 10 plus years, you're definitely going to make good, decent wealth for yourself. And more importantly, you'll enjoy for years to come, decades to come. So with this, we would like to thank you everyone for joining in. And I thanks Akhil for coming across and sharing his valuable insight on the markets as well as on the way we should look at investing in mutual fund. And I think mutual fund is one of the best platform to invest across various asset classes as well as invest across market cap. So if you are not started your journey, please make an attempt to start from tomorrow. Start your SIP from tomorrow. If you want to invest lump sum, start from tomorrow and keep investing. Wish you all the very best. Take care and have great journey on your wealth creation. Bye bye everyone. Take care.
Thank you. Thank you. Bye bye.
Bye bye.